Let's run through some of the activity that we saw on the bourse. A lot of appetite for Safaricom shares after it announced that a joint venture deal with that IT services firm, 7Seas Technologies. Take us through your idea of how this might help Safaricom tap into the corporate market more.
Well, essentially, this joint venture is focusing on managed services, and the option they've signed with 7Seas is for an option to purchase a controlling stake 2 years down the line. And essentially, I think within that period, Safaricom would have assessed the viability of this service within the Kenyan market. It looks quite positive in terms of the direction and where really Safaricom is looking at in terms of being a converged communication service provider. Obviously, the gains in terms of having a meaningful impact on the bottom line is going to be limited in the short term. But I think Safaricom is looking far out, especially with voice being challenged in the short term. And so essentially, it's just building up on its data capacity.
Are we likely to see more consolidation in the telecom space over in East Africa in general? Does this set the stage for that, given the fact that it does have the option to buy a controlling stake 2 years down the line?
Yeah, I think that's very possible. I think one thing to mention is that 7Seas had already planned to list in 2013. So I'm not sure whether this decision to partner with Safaricom is a different one or whether they'll still go on with the listing. But essentially, we are looking at players having to become very strong in terms of capitalization and in terms of the services that they offer to actually become meaningful, to make a meaningful impact in the marketplace. So overall, we think that's the direction we're going to see in this market, and players who cannot invest in infrastructure or sort of partner with other firms to be able to generate sort of meaningful products, I think are going to find it very challenging in the Kenyan market.
Yeah, it's all about financial muscle to create that economies of scale when you're looking at the telecom space. Let's move on to the banking space, given that Q3 earnings results are starting to come through now. We've had Equity Bank release its results after exceptional items, pre-tax profit standing at 9.09 billion shillings. That's a 28% rise. We saw 57% rise for the first half of the year when it comes to net income of Equity Bank. A slowdown, but still quite strong given the fact that economic headwinds have been persistent during this period and really eaten into disposable income of consumers.
Yeah, I haven't looked at the numbers yet, but yes, we were expecting a slowdown in terms of quarter-on-quarter growth, and that happened in the second half as well. And so, we are likely to see that continuing across most of the banks as sort of lending slows into the second half. And we are going to be waiting anxiously to see what the rest of the banking sector shows. But overall, we remain quite positive with Equity Bank. We think despite the slowdown, they're likely to hold up reasonably well, despite the challenges. I guess one of the key things we've been looking at is some of their bond portfolio. They've been recategorizing them to held to maturity. And essentially, this accounting aspect that does tend to skew their profits somewhat, a little bit, depending on how they've done. But we're just going to look at the numbers and see what they've done.
In terms of bond portfolios, do we have any idea of the magnitude or the volume of bonds that the likes of Equity and perhaps some of the other banks are holding?
For Equity Bank, their portfolio is about 20 billion, maybe slightly over 20 billion. But essentially, the key thing there is that some of the bonds were bought when interest rates were quite low, and so when interest rates rise in terms of mark to market, they need to recognize that in the income statement.
But at this point in time, you say they're likely to move it off the income statement in order to not have to bear the brunt of that the loss in the value of the bonds.
Yes, if they recategorize them, it's actually allowed. They could sort of buy it back and buy it under held to maturity, in which case they don't have to recognize it under the income statement. But there would always be a gap on the statement of equities.
How profitable is the forex trade for banks going forward? Because now the CBK has come out and changed the rules for banks when it comes to trading in forex and the amount of forex that they're allowed to hold on their books. How is this likely to impact earnings?
Well, I think essentially with volatility, generally banks tend to make higher profits on the foreign exchange. I think we are going to see that coming through across most of the banks. They also tend to charge a higher margin with a higher exchange rate. So that's going to filter through to the banks. The aspect of reducing the requirements to hold foreign exchange from 20% to 10% is just a natural way of sort of allowing banks to be able to realign their portfolio, to make it a lot more comfortable for them to decide either to hold a big bulk of their assets in terms of foreign exchange or in local currency. But with the local currency interest rates having increased, I think we are likely to see that holding reducing. I don't see that having a meaningful impact in itself on the earnings.
Let's take a look at the tightening interest rate regime and how that's likely to impact market share for the banks, with many of them reacting by hiking their interest rates. You've got KCB's interest rates up to 19% now. That's a 400 basis point hike, whilst the likes of equity banks still sitting cheaply at around 15%. Do you think it's wise for banks to be responding so aggressively at the expense of perhaps losing customers and market share?
I think that's something banks have to really reassess very carefully, because I don't think the current high interest rates in Kenya are going to maintain for a very long time. So raising interest rates very significantly, and we've seen KCB and NIC Bank being at the very top range of the banks raising their base lending rates. It means really if you're going to borrow from these banks, you are borrowing at close to 22-23%, depending on the margin put in. So it's obviously going to be a very big challenge even for customers. We might see the NPLs also increasing. And when the economy starts to interest rate starts coming off again, we might see customers a lot more reluctant to borrow, which might be a lot more challenging. So I think some of the banks are sort of holding back a little bit to see how this is going to play out.